Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and our model portfolio is up 2.55% year to date. Our stock market strength color signal is still green, and we try to beat the returns of the S&P 500 buy and hold investor, and their portfolio is up 7.48% year to date. So we are lagging behind them, but we are making ground from last week's action. So let's get into this week's video. Here are some past returns for the model portfolio. Last week, the S&P 500 lost 1.46%. And by the way, we use the ETF symbol SPY to represent the S&P 500, which is the spiders of the S&P 500. I'm going to show you the charts in much greater detail throughout this presentation, but you can see that we had a correction here back in 2023, and I took that and carried it over. I did a copy and paste to the same rectangle right over here in 2024, and so it's possible that we are going to be experiencing this action right now, and we are right at the beginning stages of that if this continues on and we stay in this downward trending channel. Last week, we made one trade in the model portfolio, and the trade we put on was the exact trade that I told you about on last week's video. So on Monday, 4/8/24 at 12:48 p.m., that's on Pacific Standard Time. So that was about 15 minutes before the market closed on Monday. We ended up buying one long put, and we did the 6/20/25 expiration. So we went out a good long ways, and we did the 470 strike, and that premium at that time was about $15.44. Here are the trades we've made in 2024. If you want to see all my trades going back 3 years, you can head over to this link. It will be in the description down below. If you have not done so already, hit that subscribe button, ring that bell, and smash that like button down to help me with this video. Thank you. We currently have 3 open positions which are highlighted in yellow. Those are not closed positions, they are open positions. And that is where we stand. So on the put trade that I made on the 8th, we are currently up 12.95%. Now, we do have an in-the-money covered call, which is this one right here. So this covered call has a strike of 465, and this, a couple weeks ago, we were down about $4,000, but now that the market is softening, now this one is only down $3,000. So as the market drops, this negative number here will get closer to zero, which is good for us. So because we're not going to lose money on that, because that our debt obligation on this will be less. And the intention is to let the market correct, wait till it bottoms out, and then we're going to buy to close this maybe for $1,000 or something like that. Now, keep in mind, because this was an in-the-money covered call, we got paid up front. So we did get paid up front for the transaction at that time of like $11,000. So it's okay to spend $1,000. Actually, hold on, that can't be right. We didn't get paid $11,000 because the portfolio's got only a total value of $102,000. But the point is that we got paid here. So as this drops, it's okay for us to buy and close it, but I'm trying to get that number as small as possible. Here is the equity curve for the model portfolio for 2024 year to date. At least it's steady and up. It's just the profits aren't as good as we want them to be. Here's the equity curve for the buy and hold investor. Now the point from here to here is really somewhat just remarkable. It's usually the S&P doesn't go up quite so strong, quite so fast. So having this correction is certainly not out of character at this point in time. You'll notice that where we're at right now is the approximate point that we were at 1, 2, 3 for about 1 month ago. So we'll see what happens here. But if that falls down below this level here, then the next support level is going to be down here at 500. and so forth. Now, here are the two equity curves combined because we always want to compare our model portfolio against the benchmark, which is the S&P 500 buy and hold investor. Now, the percentage gain was much different 2 weeks ago between the two portfolios. Now, because of the sharp drop in the S&P 500 in our portfolio slightly advancing, that gap is, you can see, narrowing, but they're still beating us. So you got to give credit where credit is due. And being a buy and hold investor compared to my strategy for the model portfolio has definitely been more beneficial. So we do want to recognize and acknowledge that. That's important. But again, we want to beat this the buy and hold investor before the end of the year. That's our goal. We want before the end, by the end of the year, we want this blue line to be above this pink line. So that's what we're striving for. We're hoping to do that. And stay tuned to my channel if you want to see if I do that, when I do that, and more importantly, how I do that. This is the Fed Chair Jerome Powell regarding Fed interest rates. Now, the last announcement was March 20th, where the Fed holds the rates. Didn't do anything. Now, the next announcement will be on May 1st. So right at the beginning of next month. And the expectation is that the Fed is going to hold rates again. He's talking about cuts, but the inflationary rates are exceeding their mandate, which means that they don't really have the data to support cuts, which is what the Fed chair was talking about. So it seems more likely that they're going to hold rates on that next announcement, but we will see. All right, now we're looking at things from the presidential election cycle theory, which states, depending upon the year of the election, you have historical rates of return for the S&P 500 and for the NASDAQ 100. Currently, President Biden is in the fourth year of his term, which historically for the S&P 500 has averaged a 6.7% for the entire year. Currently, the S&P buy and hold investor is up 7.48%. Giving room for this to come down between now and the end of the year, but by only 1 percentage point. The point is that there's going to be plenty of turmoil between now and the end of the year to meet this historical average. Now we are looking at things from the bond market, and the bond market is supposed to be smarter than the stock market. They're 4 times the size. Currently, the bond market is telling us equity investors to be out of the stock market because we have an inverted yield curve, which is not normal. We have been in it for so long that it seems normal, but it's not. Also, we have rising interest rates. So with an inverted yield curve, your short-term yields are higher than your 2-year and 10-year yields, which are lower. That's inverse, and that's why it's an inverted yield curve. This is Warren Buffett. He is the Oracle of Omaha. Some say the greatest stock market investor of all time. This is CNN Business Fear and Greed Index, and we monitor the fear and greed with this index, and currently we are at 46%. 1 week ago, we were at 62. The needle was actually way over here within a very short time ago. And now it's dropping down towards almost jumping into the fear, which I suspect it's going to get into the fear and possibly even hit extreme fear between now and the end of this correction. But we shall see, and we monitor this. Now we are looking at things from a seasonality outlook. Now, for the month of April, going back the last 20 years, there's an 80% probability that we are going to close the month higher than when we opened it. Well, currently the month of April in 2024 is down 2.34%, which means that this market would really have to turn around. Now, even though there's an 80% probability we're going to close higher than when we opened, there's still a 20% probability that this negative condition is going to remain. But we do want to see what's happening on a seasonality basis, because right now we are fighting the historical average of being positive 80% of the time. The month is about halfway through. So we'll see what happens next week and keep an eye on this. but it's very possible that the market is going to reach some level of support here and start to move at least sideways. So I'm not going to take on another put at this time unless the market starts dropping remarkably and breaking support levels. I think next week is going to be a flat week. And this evidence, this data supports that thesis. Now we are looking at things from a long-term outlook. This is a monthly 20-year chart showing you the long-term bull market that we are currently in. And we were on an unsustainable trajectory and we are starting to soften up. But that's absolutely normal. This was unsustainable. This had to happen eventually, and it's happening now. So we're just keeping an eye on that. Last time it happened, we fell into the moving averages, found support, and then went north. Is that very well could happen right now. We're going to fall down possibly into these moving averages, find support, and move north again. That's my expectation. Very similar to what happened during the last correction in 2023. I think we're going to get a similar correction right now in 2024. We'll see. We shall see. Now we are looking at an intermediate term outlook. Now here is where I told you about that earlier in the presentation. I told you I took the rectangle from the last correction in 2023. I just copy and pasted it over to 2024. Now we're watching it. A 10% return will give us some support in the 470 number. And then here there was a 10% correction from here down to here. And if that happens, if that happens right now, that gives us a number of 470. So let's see if the market finds support in this number. If it does, that's where we're going to buy to close our in the money covered call, close out our put, and start taking on longs. So that way, when the market does this again, we are positioned with more leverage to the upside. But for now, you can see that the MACD is way up here at a number right around 20. So it's got a good amount of room to fall before it finds that support and turns back around. Now we are looking at things from a short-term outlook. This is a 6-month daily candlestick chart. This was the trend channel that the market was finding support in for a long time, and now we have just broken out of it. We are now beginning to trade sideways to down. And you can see that with Fibonacci retracements and put in here as well. Now we are looking at a ratio chart from the NASDAQ 100 to the S&P 500. Here is the trend channel that we were in. We broke down out of that, found support at previous support levels, and have bounced out of it. But this is the 50-period moving average in green. You can see where it kissed it perfectly and is now coming down. So it looks like we may be coming back down towards this support level, which is bad for stocks over this time period right here. Because generally speaking, in a healthy stock market, the NASDAQ 100 supersedes the S&P 500. Now we're looking at another ratio chart from the equally weighted S&P 500 symbol RSP to the normal cap weighted S&P 500 symbol SPY. That's this black and red chart right here. In the last 20 years, we fell off of a cliff 3 times on the ratio chart, but the S&P 500 only fell off of a cliff twice. Here 40% and here 19%. Here we are back up here in the stratosphere. Are we going to get a 19% drop? I doubt it, but I do expect somewhat of a drop right here. And that will be really healthy because after the market did this correction and moved sideways and did this correction, it didn't even move sideways. Look at that. This is where I plan on making all my money right here. And right here, look at that massive run. We have to get through this point here and here over here in 2024, hopefully 2024. I hope it doesn't get extended to 2025. We shall see. But we would like, it would be healthy to see this happen, have this correction take place, hopefully not lose our shirt in the meantime, and then make the real cake. Now we are looking at the VIX, or the Volatility Index, or the Fear Index. I've got 3 ranges in here. Below this green line is the ultra low range. Between this green line and this green line is the low range because it's below 20. above this green line, above 20, that's when you start to really lose some cake, because that's when the fear is really kicking in. And it's kicking in because the market, which is in this dark blue line here, is dropping dramatically. Right now, the fear index is on this upward trading trend channel. We broke out of it a little bit here, but came back into it. And look at last week's action here. Last week's action, especially on Friday, it shot even above this trajectory, which it did here as well. And then it had a soft spot and then it came back up again. But generally speaking, you can see that we are trading an upward trajectory here, meaning that the fear of the market is absolutely increasing. So during this time frame, the S&P 500 is breaking down. Now we are looking at the Thinkorswim platform. This is a 5-year weekly candlestick chart and we also have standard deviations, +2, -2 in gold, +1, -1 in pink, the regression line or the 50%, the midway point in dashed green. Currently, we are at 0.5 standard deviation and have reached a top and is coming down. Now we are looking at the same information, but instead of going back 1 year, we're going back only 6 months. Here we've got our sell and buy zones. And here on the standard deviation chart, we're a negative 0.45. So we are coming down, getting closer to that -1 standard deviation. And we know that there's a 68% probability once we reach that it's going to want to find support and come back up. But we shall see what happens here, and we are watching. Now here is a spreadsheet that I developed, and I'm just trying to keep an eye on asset classes and the 11 S&P 500 sectors. And I determine what that strength number is based off of this information here and compare it to last week. Last week, across different asset classes, we were at 92%. We dropped dramatically to 83%. The S&P 500 11 sectors was at 85% and now is dropped to 80%. So you can see weakening happening across asset classes and across the 11 S&P 500 sectors. Here is a 1-year chart for the 10-year bond yields. Here you can see that bond yields are clearly in a rising trend channel. This support line, which was resistance, and now it's because it's on the north side of this line, was going to act as support. The market does not seem to like trading above this number right here. That is when the market started to come down out of its upward trajectory channel and starting to head south. So this is the area that the market does not like the bond market to be trading in. And we're currently trading in that area right now, and the market does not like it. Okay, I just gave you guys a ton of information in this video. Now comes the critical thinking. What do we do with that information? Well, as of March 13th, 2024, the market summation, according to me, Ken, your friendly host with SPY Trader Now. The market has just started to break down out of its long-term uptrend. This is basically copy and paste from last week. And it looks like it's due to the 10-year bond yields rising. I feel very strong about this market dropping 10% in the next 12 months. I mean, I would think that that is to be expected. I did put on the below trade, this trade right here on Monday, 4/8/24, which is now profitable by about 13%. So that's good on that particular trade. Like I told you during the video, I'm going to hold off on taking another put and putting more leverage into the put side of the market. I'm going to wait and watch next week's action and then go from there. I hope you got some valuable information out of this video. If you have not done so already, hit that subscribe button, ring that bell, smash that like button down. I thank you, and I wish you good trading.